Hello, everyone, and welcome to today's live webinar, AI Economics, TSIA's Perspective on Profitable AI Business Models. I would now like to introduce our presenters. J.B. Wood, TSIA's President and CEO. Thomas Law, TSIA's Executive Director and Executive Vice President. And George Humphrey, TSIA's Senior Vice President of Research. As with all of our TSIA webinars, we have a lot of exciting content to cover in the next 45 minutes. So let's jump right in and get started. Thomas, over to you.
Hey, thank you so much, Vanessa, and welcome everybody. Today we talk about our perspective on profitable business models in the era of AI. It's part of our research around AI economics. And just a couple promos here. We believe deeply that AI is changing the way people work, and we have invested in creating an incredible AI capability on the TSIA portal. And we really encourage you to take advantage of that. It leverages all the research that we have done across all of our research practices. And so that is a great experience. And the theme we are on today here, this body of work that we call AI economics, you can link to it. There's just ongoing content on this. There's keynotes we've done. There's an ebook on this. So if this is a topic that basically you're interested in, definitely take time and go out to that page, and you'll get even more resources. So let's get into it. What are we going to cover today? I'm going to open up with talking a little bit about executive sentiment, what we see out there, and how people are feeling in this current environment. We're going to talk about the core questions of AI economics that the TSI is working to answer. Then I'm going to turn it over to George Humphrey. He's going to talk about a new index that we're tracking called the AI20. J.B. Wood is going to talk about the new competitive landscape. George is going to talk about the era of services. J.B. is going to talk about how the engagement models are changing. And then, very importantly, we're going to open it up for Q&A. So we're going to go through this stuff pretty rapid fire, get stuff on the table, and then any questions you have, we'd love to hear from you. We're going to leave at least 10, 15 minutes for Q&A. So that is the agenda. And let me start out with executive sentiment. So we just had a conference in Vegas, our Envision conference. And at that conference, JB and I did a survey with our executive advisory board. And this is a who's who of tech companies that sit on this board. And we asked them about 20 questions that they could answer anonymously. And then we reviewed the results with the board real time. Really interesting exercise. But just here's some of the questions that we ask in the responses. So this first one, 100% of the executives in that room believe that AI could replace a third to 2/3 of service labor for the current services. So current support, education, professional services, et cetera. Massive number. 0% of these companies are confident they have the right service portfolios around their new AI products. 83% of companies are contemplating new pricing models. George and JB and I were literally just talking about this before the webinar kicked off, about just how much consternation that we're hearing out there around pricing. How in the hell am I going to price AI that I keep the value that I'm delivering there, that I unlock that. We know user-based pricing is going to work. Consumption-based pricing we don't think is ultimately the winning model. So where are those models going to go? That is a big topic. You can see most people are low certainty there. 89% believe that ultimately value or outcome-based pricing is going to be explored by their companies. We are firm believers in that as well. And 72% of these companies, again, this is a who's who list of tech companies, are concerned that their company, regardless of how big and bad they are right now, could be disrupted by an AI startup. So the net of this, in terms of sentiment, is there's just a lot of uncertainty. There's more uncertainty in this industry around the future of our business models than TSIA has ever seen in 20 years. And then another key thread in the current sentiment is just how are companies going to leverage AI to become more operationally efficient? Man, that is on the table. And we have been saying for 2 years to our members that, this train was coming to your station, and it has landed in a big way. And so now, 2 years ago, executive teams didn't really want to talk about how AI may change, headcount or whatever. Now they're out there saying, hey, no. We are definitely going to change the way that we're doing business here. We're going to definitely optimize. And this is now absolutely a feature, not a bug. If you look at, AI intensive companies like Google, Alphabet, Microsoft, Amazon, Palantir, all of these companies have decoupled revenue growth from employee growth. So the game that's being played here is, how do I grow revenue with the same or fewer employees? So that's huge. And all of this is, again, creating a lot of uncertainty. We are working with AI economics in this body of work to answer some fundamental questions for our members. How AI startups are going to, enter these markets. What a profitable AI business model is going to look like. Uh, Pricing, again, where's pricing going to go? User base, basic consumption, we don't think is going to be the winner there. Um, we believe firmly, we'll be talking about this today, that AI is the era, not the end of services. We believe new service capabilities are going to be required and new service portfolios are going to emerge. And some of this we're going to talk about again today. And a little update here. We did these keynotes in Vegas. We put some of this content on the table, and we were augmenting that today and adding some more insights. And one of the things we wanted to talk about was this new index called the AI20. And George Humphrey was the brain trust for this. He came up with the idea of creating this index. And part of the catalyst is all of us at TSIA, the research team, we were looking at the profitability profile of these AI companies and what was their strategy, their talk track on how they're going to become profitable companies. And it's pretty stunning because, and this is a real quote here from Sam Altman, and there not much has changed since 2019. And the net of it is, there is no story on how they're going to be profitable. They got a story about how they're going to get more revenue growth. They got a story about how they're going to get more investment to build out the data centers. But how do you really make this a profitable, viable business? That is unclear. And so that's the reason that we wanted to stand up this index. So George, let me turn over to you, and you can put a little more meat on the bone here around this index.
Yeah, absolutely. So, little backstory. In 2012, when I was talking to the leadership team at TSIA about potentially coming on board, I sat and watched a webinar that was called the TS50, the Technology and Services 50 Index. And that sealed the deal for me. I said, oh my God, these guys totally get me. They're telling the story of the tech industry that most of the leadership of my company didn't even understand. So that was the first index that really painted a picture for where the market had been and where it was and where it was going. Fast forward a few years later, we introduced the Cloud 40 Index, and we've been doing a quarterly readout on these for the past several years, where Thomas unveils where we are currently on any core snapshot of the tech industry. I like to personally compare the TS50 to the Dow Jones Industrial Average. These are companies that have been in business for a long time. They're publicly traded businesses. They're struggling with growth. They want to become more like cloud companies or subscription provider companies. And that's where we see the Cloud 40 Index. These are 40 born in the cloud companies. I compare these to the NASDAQ. They're typically much higher growth, lower profitability. So it's like the anti TS50. Again, the TS50 wants to become the Cloud 40. Well, here we have the new AI20, and they are the disruptor to these two. There's no great index in the industry in the publicly traded market right now, maybe some ETFs around AI growth, but this is really giving us a great predictor of the future. And it's 20 publicly reported AI-centric companies. And so if we take a look at who those companies are, they're from a lot of different backgrounds. Again, AI is at the heart of the focus of this business, these businesses, publicly traded companies, again, where we can take the pulse. What's really interesting is, like any index, yeah, you'll have to update it and adapt it over time. Some companies may fail to or cease to exist. In the TS50, less than a third of the original companies that we started to track in 2008 still are in existence. Well, this is changing even faster. Already, I had to remove one company that was taken private and replace it with another one. But here's a good snapshot of who they are. Even more interesting is if you take a look at their financial profiles, and you could see the OI and the gross margin of these companies is all over the place, but the revenue growth rate is like a rocket ship for most for most of these companies. High growth and profitability. If you take a look down on the average and median, they're really struggling. An average OI of negative 129%. Yeah, median is probably a better indication of where the aggregate really is. The most concentration, negative 31% OI. But like I said, it's changing fast. And so, just a quick update we did this morning. The one I'd really like to call out is Palantir. So, I just gave you the doom and gloom of the negative gross margin and OI. And Palantir is really the poster child. They're the new benchmark, if you will, for how AI companies can perform. They have an incredible OI of 33%. That's up from 27% last quarter. Their gross margin is an incredibly healthy 83%, and their revenue growth rate jumped from last quarter at 43% to 63% at this quarter. So this is definitely the index that everyone else is going to be watching. So every traditional TS50 company, every Cloud 40 company, now they're trying to become an AI company. You can see it in all of their earnings. You can see it in all of their marketing. You can see it all over their website. But these companies, they're not created equal. If you break them down a little bit further, there's three major categories. The AI unprofitable, deep R&D investments with massive negative operating margins. Think about it like this. OpenAI, no, they're not public, but we do have some insights into their performance. $13 billion in annual revenue this year. Yeah, they expect to end the year at a run rate. We heard Sam talk about maybe 20 billion. Their goal next year is $100 billion in revenue, but they've already committed to spending over $1.4 trillion. So they're hoping to maybe get to profitability by 2030. Then we have these AI scalers. These companies really have a very tight product market fit. Yes, they have a capital intensive focus and really a lot of investment. At the end of the day, their GAAP net losses are masking their profitable core. You can take a look at their GAAP earnings, their non-GAAP earnings, and start to see how this is unfolding. And what we're seeing them drive towards is becoming one of these AI leaders like Palantir that I've just mentioned. They've proven themselves. They have a very tight fit with their offers to their customer needs. They're paying their requirements and they're growing like crazy. They've turned the corner. They're now profitable. There's also another dimension to take a look at these companies in the AI20. So one is to really strip out the ones that are software focused. And these companies, they're starting to look a lot more like the SaaS companies. Their growth is starting to come down a little bit. No one can sustain 60% or 100% growth rate year over year for a long period of time. So growth starts to normalize while bottom line profitability starts to improve. So those AI20 software only companies, they're really the ones that are painting the picture for the path forward for any company that is focusing on AI as a core part of their value proposition to their customers. So with that said, I'm going to hand it back over to JV to talk about the new landscape, those contenders that are in the battle right now.
Yeah, thanks, George. you know, um, we want to talk a little bit about why this matters so much. I mean, out here in Silicon Valley, there's a lot of there are a lot of opinions that there is going to be an enormous amount of enterprise spending on AI, and that it hasn't really even begun. I mean, there's a lot of piloting going on, and that piloting is enough to fuel, revenue and sales increases at some companies. But the reality is, like in the crossing the chasm model, those big, thick parts of the market are really sitting on the sidelines before they're opening their checkbooks, but they're going to open their checkbooks. We really feel like AI is one of the rare cycles that comes along that is really going to cause a lot of enterprises to largely gut a lot of their traditional tech and replace it with next generation equipment. So there is a huge amount of spending and opportunity that's going to creep up here in 26, 27, 28. And there really is a race that's going on in terms of who is going to capture all of that big spending as it comes along. We've been talking on the left here about these, very well funded new AI companies, and how they're coming to market, which we're going to talk some more about. And then there are the current incumbent leaders. And again, Mark Andreessen's fairly recent quote that all the incumbents are going to get nuked. He is really and a lot of other people are of the opinion that the big market leaders, because of their legacy technology and equally their legacy business models and ways of operating, create competitive disadvantages for them that open the door for these new AI companies. And we're already starting to see, you know, really important changes in how AI companies are evolving their thinking in terms of not only their business, but the actual, way customers are going to consume those businesses. So, a lot of in the early moments of these AI companies, they say, hey, well, what we've really got is an engine here, and you can subscribe to that engine, and maybe the more you use, the more we charge you. Eventually, they are going to try to build apps. I was just reading an interview with the new CEO of product for OpenAI, and just talking about the importance of building the applications. And then they may have services for their enterprise customers that are going to help them extract value from the engines and from the apps. But already we're starting to see the blending of the apps and the engine, so that you just consume the engine and the applications are running in the background. And ultimately, what we think is, and that's where AI is heading. Excuse me, where OpenAI is heading. But what we're really starting to see is this model of maturity, where it's kind of everything together: the engines, the apps behind them, the services, and really focused on the business outcomes that are being generated. And that is what Palantir is doing so successfully. And again, at a time when user-based pricing is under a lot of duress, and a lot of enterprise software companies know that that is not the way forward for them, and they're casting about for what is the next pricing anchors. Here is an example of a company that is monetizing customer outcomes considerably, and is achieving, as George just showed, huge gross margins and huge net OI. And we also know that there's vulnerability. I mean, all that is required is for one of these new AI companies to say, hey, we've got a new feature or capability that is similar to what an existing incumbent does, and it can rock their stock price. I mean, that happened with DocuSign, again, when OpenAI announced that they were going to be able to have similar capabilities. That happened with Adobe, one of their product lines. And so there is vulnerability, and these incumbents have got to figure out how to do this, to be competitive, to rapidly transform their pricing models, their services capabilities, all the things that are required to compete in this new era. George, let me turn it back to you to talk a little bit about what we think that means, at least from a services capability side.
Yeah, absolutely. At the heart of it, and it might sound a little bit like a broken record because we've been talking about it in tech for a decade now, but it's coming down to value and to outcomes. Can you discover, define, and defend the value that you know that you can commit to, that you can guarantee to your customer, that you can deliver to their business? Again, to call on OpenAI. Their professional services business right now is a $2 billion business. They expect it to be a $10 billion business next year, because they know if they embed their forward deployed engineers into a customer's environment, they can identify faster than the customer can how they can deliver value using AI. Then they go ahead and deploy those solutions with very rapid deliverables that demonstrate almost immediately value, an instant ROI, if you will. And then they continue to tune those models and those solutions to continually drive value, increase value, drive natural expansion through value and through operational insights for those customers. So we did this paper called Three Service Drivers for Three New Service Offers. And that's really where we're seeing these companies accelerate. It's about monetizing those services that many in the tech industry just gave away, starting with AI readiness and governance services. Is the customer even ready to get value out of AI? Do they have their data systems in order? Do they have a strong governance system in place? And again, can they even imagine what's possible? So, a lot of strategy and design activities for the customers, all highly monetizable services. Picking on OpenAI again, they won't take a professional services gig unless it's a $10 million or more opportunity for them. That leads into value optimization services. These environments are constantly evolving, adapting. They're living, breathing solutions. They require constant healthcare for them, constant optimization of the models, the data drifting and the model drifting, and the operations environments. So, continually managing and operating those environments for the customer. It's the only way you can really guarantee the outcome. And that leads us to these outcome oriented AI services where the product is part of the service and the service is the product to the customer. You can no longer separate those solutions, completely managed and operated so that you know you can deliver these solutions. Again, it doesn't mean that every company has to become a managed service provider, but a managed service is part of the solution you're selling to the customer. And so if you use a partner model for that, you have to think about those partners as part of the offer design process. It's the only way, again, you can guarantee those outcomes. So those are the three new categories, a full paper on all of those and some papers on each of them individually. And really what we're seeing is this massive migration of tech services. So there's these two sides to the AI coin for companies that are leaning into this new era. One of them is like I just talked about, all the new offer creation opportunities, the monetization of services, but then also how you free up funds so that you can invest in those new models. And this is where we see AI eating into the delivery of every single service. Things that are well defined, well understood, process oriented services that are frankly causing a lot of pain inside, a high cost. Those are the ones that we're seeing eaten by AI, whether it's content and course creation and education services, or initial deployment and topology mapping for professional services, initial ticket resolution, automated resolution and support services, automatic correlations against things like configuration management and capacity management and managed services, auto health scoring for customer success. We're seeing all of these areas eaten by AI. That's freeing up operating expenses to turn around and reinvest them in additional new AI capabilities. So, Thomas, I'm going to hand it back over to you to double click into a little bit of that as we talk about the revenue streams in AI.
Yeah, absolutely. And hey, by the way, so one of the questions that came in here was, what's AI tool we recommend for T1 triage of tickets? And so I'm going to go into that and on this webinar in terms of specific tools, but just asking that question is a great example of what George is talking about here, where these traditional services where you could monetize, right? Like basic level 1 support, there was value there. Customers saw that. A lot of that is that value is going to go into the product. It's, AI is going to solve those problems, automatically. The customer's going to be like, well, what am I paying you for here, right? And so that's why it's really important to be thinking about how you climb up and put new service opportunities, on the table. And there's really two kind of arguments that we have around this. And again, we have this tag line of around how we believe this is not the end of services, but the era of services with AI. Why? Because number one, what George just put on the table is there are areas where customers need a lot of help related to AI. Those new categories are real. There is a well understood last mile problem right now in the world of AI where customers need help to really get the value. But the second lens on it is just what it's going to mean to your business model. And so there's four ways you can take money off the table around your technology. You can charge the customer to access your AI technology or platform, whether you do that consumption-based or some other way, but that's one way. You can charge for consulting to help the customer. You can have recurring services, which look like premium support, managed offers to help the customers keep getting value. Or you could do these outcome type offers, which are typically a blend of technology and services together to unlock some specific outcome the customer cares about, and they pay you for that. And we already see different models in the wild. So OpenAI historically right now is a model that is very focused on monetizing the core technology, and they've now just start to raise their hand and say, hey, we also think we could do consulting around that. That model right now is unprofitable, that state. The polar opposite is Palantir. If you look at their model, they are very sophisticated in all the different ways that they monetize. They charge for access to their technology. They charge for project-based consulting. They charge for recurring support in managed services, and they also do outcome offers. They do it all, and they are highly profitable. Our big assertion here is that the business models, on the right, become much more, profitable. And again, George already talked about this, but when you just look at the gross margin or the operating income percentage for this company, it continues to grow, and they're not alone. We really believe there's going to be a whole new class of these types of AI solution providers that have that complete thought of technology plus services together to get to the outcome of the value. Another example of this is Distill. Their first valuation was $175 million. 9 months later, they're worth $1.8 billion. It's insane. And I'm looking at the attendee list here. The vast majority of you people are from product companies, hardware companies, software companies, and historically for you, scaling product revenues was the way to get a high valuation. Palantir, Distill are proving a different thesis. It's the ability to deliver business value and outcomes that investors are getting really excited about because they know it's those companies that are going to take a lot of money off the table in the world of enterprise AI. So with that, it means in that type of world, that type of model, it is a different type of customer engagement model. So JB, I want to turn it over to you to tell this perspective.
Yeah, I characterize this as a race, right? A race to be the vendor, the supplier of choice when large enterprises really open the checkbooks for their big spending. And these AI native companies, they are unencumbered by a number of things. They are unencumbered by the responsibility to make money in many cases. But equally important, I would argue, they are unencumbered by legacy workflows, business processes, org structures, all of those things. And what one of the elements of the race is really how quickly the incumbents can get out of their own way and translate the old scale and capabilities into new scale and capabilities that better align to what we think these large enterprises are going to expect, and how they are going to expect to consume it. And we were the authors of the layer model, land, adopt, expand, renew. And we're out here saying, well, we think AI is a little bit different, right? As Thomas was mentioning and George was mentioning, there's a design phase where you really need to get in with experts to understand, first of all, the readiness of customers to deploy AI solutions and where the use cases are. Then you got to quickly activate those and show value. And then as you do that, you start to say, okay, now we're going to scale that value and realize real activity, real business results, and eventually evolve not only the ones you started, the use cases that you started, and make them bigger and more successful, but also this ongoing responsibility to identify the next use case, the next source of value, the next business outcome for a customer. And, it's being written about a lot. These forward deployed engineers are a great example, the hottest job in startups. And they are a bit of a unicorn, but they're the ones, these are really, it's a services role, regardless of where that engineer sits in the organization. They're providing a service to that customer by walking them through these phases. And ultimately, they're generating revenue as they go, revenue for the customer, or cost savings for the customer, but very importantly, revenue for the AI company. And let's face it, every one of those stages, design, activate, realize, evolve, they all can be billable. They can be billable. But we really think it's kind of a staged approach. In the beginning, your new AI offers, which may be somewhat unproven, or rely on a lot of customization, you're going to give away a lot of the design, activate, realize in order to begin to charge for the evolution of this value and the growth of that value. As you get more focused and capable in doing this, then you can start to march up this maturity model to the point where you can begin to charge for more and more and more of the phases, because you have proven in your market that you are a trusted advisor, that you get results, you deliver outcomes, and the ability to monetize your capabilities increases as you demonstrate that. As I mentioned, one of the things we are super nervous about for the incumbents is their ability to, you know, make the elephant dance, right? So if you think about the stages that we're talking about, there is still a pre-sale stage, there's still onboarding, there's, ongoing value realization, there may be a renewal phase. Um, Incumbents have very specific organizational roles and responsibilities across a journey like this, a customer life cycle. But these AI native companies, they're not worried about that. They're not worried about whether the FDEs sit in services or sit in pre-sales, or they're not worried about as much about structure and about, internal cost accounting and those things, because quite frankly, they don't have to. They are more simply concerned about delivering value and outcomes and monetizing those value and outcomes. And so, we, the incumbents, cannot spend years internally arguing about where resources sit or who gets what revenue. And it's going to be a difficult challenge for them because they've been so hardwired and worked so hard for so many years to have all these rigid processes and accounting structures. And now all of a sudden, the race is on to be able to deliver and value outcomes for customers. And you have a bunch of new AI startups that don't care about that stuff. They're all on board around the value and outcome generation for the customer. So there are multiple challenges in getting to where we think the business models need to be. And the incumbents, while they have massive scale and can, if they get it right, are going to be in the driver's seat to go perform these functions for these big enterprise customers, they're going to have to move quickly and they're going to have to break a lot of internal glass. So I think with that, we want to open it up to a couple of questions here. And so I think, Vanessa, I'll turn it back over to you.
Hey,
Wonderful.
JB,
Thank you so much.
hey, well, we're waiting. I'm going to give people a second to get some questions in. I see, looking at the queue there. But there's one thing, I'm just going back to this slide, JB, I just want you to comment on here, because you and I were having this discussion last week. You came back from a conference and you were talking about the fact, because people were talking about articulating business value to the customer. And how do you do that? And that's a skill and a muscle that every technology company needs to be better at. And that we see, and you saw that conference, companies are clearly starting to get more serious about that, right? To invest in how they tell that story to the customer. But you saw this as really a heavily invested on the pre-sale side. And what you and I were talking about is it needs to be the complete thought to close the value loop. So just want to comment on just your observations there.
Yeah, well, I mean, again, enterprise customers were already and are only now accelerating their interest in having vendors, talk to them about actual business results, right? And so I'm not going to buy features because you tell me the features are great. I want you to close the loop for me between how those capabilities are going to generate real revenue, real cost, and so forth. That was already underway. And all of this things we've been talking about, just in the last half hour, are just throwing fuel on that fire. And so what we're seeing is that, that the sales organizations are realize that they have got to get more mature, more sophisticated in talking about value realization and business outcomes. But to your point, the complete thought is not there for most companies. And so it's not just about making the promise, it's about proving the result, scaling the result, monetizing the result. And, I mean, you have to ask yourself, at most of these large tech companies, who owns that? Who is actually measuring and monitoring the value creation, the results, tweaking them, making the changes, reporting back to the customer, creating the data that is going to be the basis of the monetization? Where is that maturity? And so, it's one thing for pre-sales to race ahead and make promises, but what really has to happen is it has to become an sort of a part of the DNA of the company, that we're not just making the promises. We're delivering the results. We're accountable for the results. We're reporting the results. We're monetizing the results. And we would argue there's a lot of immaturity about, on the sort of the back end of that cycle. Once the promises are made, what happens after? And that's just not going to stand.
Yeah, for sure. I'm sorry. Hey, Vanessa, back over to you. I just wanted to get JP's perspective on that.
Understood. Thanks so much to all of you. And I mean, we have an AMA with JB, Thomas, and George right now. So if you have a question, now is the time. Ask them anything. Our first question, though, that I will start with comes from Dora. And it was while you were speaking here, George, and they say, these companies have implemented AI and have shown growth. Is this just general AI or focused on AI pricing use?
Yeah. So the short of it is these companies are AI centric at the core of their DNA. Their entire value proposition is really woven around, we can deliver business results because we are an AI powered, what we have sometimes called an AI native company. And that's in stark contrast to many of the incumbents that say, hey, I'm an AI company too, because look at the cool features I just enabled that are AI centric in my portfolio. So it's not just a pricing gimmick, though pricing is very much a part of their disruption and differentiation. Many of these companies do price on outcomes, and they can confidently commit to those. We've had companies talk about outcomes, again, for over a decade. But like JB just said, are they closing that value loop? Is it on a brochure, or are they willing to, with their CFO's permission, commit company resources to delivering outcomes, and that determines whether or not they get paid?
Vanessa, can we look at Mark's question there?
Absolutely. And we had a couple questions about incumbent sentiment. So, Mark specifically is in your discussion with the incumbent elephants, do they agree with your perspective? And if so, how are they adapting?
And I will say, and again, it's a generalization because there are many companies moving at many different rates of speed. Uh, the agreement level is very high. The action level is relatively low. And, this is precisely why there is so much private money going into these AI startups, because they believe they're going to disrupt the incumbents because the elephants won't move. And the incumbents have the burden of this quarter and the burden of this financial year. They have the burden of their comp plans, their accountability, their reporting systems, and we really think that the speed that the incumbents are moving is too slow, and that there are like vastly different approaches. Again, how you sell and service, and how those organizations work together, how you price, how you demonstrate and define value creation for customers, what you charge for, what you don't, where the margins come from. there's going to be a big rethink here, and the question is, there's a boat anchor for public companies, which is their earnings forecasts, and so they have got to balance both of those things. And again, this is not dissimilar to when we wrote about the fish model, when companies started to realize that they preferred subscription-based ARR to transaction-based product revenue, and they had to go through stand up customer success and make a lot of different capabilities and investments and so forth. Then because quite frankly, the business model changed, but that took them a decade, and this is going to go way faster than that. And so so the incumbents, they agree in theory with these things, but the question is, are they willing to break glass in the short term to pilot, experiment, take groups of people and forget all the old structures and all the old cost accounting, and adopt some of these new structures, and to begin to formalize their ability to capture value and monetize value. That's the race. That's the race.
Hey, JB, and just to build on that, I think the difference that we are observing from what we call the as a service transformation, right? So incumbents saying, look, I'm going to go from selling CapEx and on-prem and eventually get to more recurring and in the cloud. And we saw companies take years and years and years to get through that transformation. And quite frankly, they were chasing better valuations. They wanted to keep, they want to get better revenue growth, and they want to, that was the game. But they had a lot of time, and for most of them, it was not an existential threat. This is different. This is existential. I mean, incumbents could get disrupted here in a way where their business is gone. And number one, number two, this could happen super fast, which is why, to your point, we feel companies are moving too slow. And I literally was on a call earlier today with an executive team talking about AI economics, and one of the folks said, well, isn't it better to be a second mover here because there's so much uncertainty, and isn't it better to just kind of wait and see what the winning moves are and then move? And we strongly believe waiting, it's too late. It's too late. So,
I'll go further and say,
it's a different game.
I'll go further and say, even if you start now, you're late. And that what we're here to say is that there are already best practices emerging, right? I mean, that it is, you are already not going to have to pioneer your way through this. There are already clear patterns of behavior and outcomes and results and practices and processes and so forth, that we're seeing. I mean, Ivo's got a question in here. Is there a migration path from layer, land, adopt, expand, renew, to dare, the dare model we talked about, to accelerate the value loop? And we're actually working on a paper on this right now. But what's so interesting, if you just look at those acronyms, LAER and DARE, what's happening is that the steps, some of the steps that used to be sequential, like after the land, you do the adoption, you do the expansion, those were like in serial order. Now, all of a sudden, in design and actualize and realize, those can be really part of the land, right? And so it's really taking some of the capabilities that we built out in the layer model, but were, again, very sequential. Sales owned the land, CS owned the adopt, and so forth. That's what's going away. Now, all of a sudden, those capabilities in a bundle are all becoming really a part of the land. And so, so there is a clear pattern in how you move from a layer-based model to a dare-based model, and we're working on research to put some muscle around that transformation.
Again, thank you so much to our presenters, JB, Thomas, and George, for delivering an outstanding session. And thank you to everyone for taking the time out of your busy schedules to join us for today's live webinar, AI Economics, TSIA's perspective on profitable AI business models. We look forward to seeing you at our next event. Take care, everyone.